if we're talking about investing outside of just the stock and bond space, especially for investors that want to stay moderate or conservative with a portion of their portfolio, you can start to look at things like private infrastructure and private credit. These are areas that are typically labeled alternative assets. And alternative assets, all that means is it's a holding that doesn't fit into the public stock or public bond bucket. It's something else. And when people think of alternatives, they typically think private equity, but it's so much more than that, so much more than just hedge funds, right? So, especially with private credit, what's interesting about these kinds of assets is that if you look at bond funds, typically you're going to get maybe 4.5% yield these days in your typical bond fund. With private credit, those yields go up significantly. You can get 9.5% yield from private credit because those companies are going directly to these private credit issuers instead of going through the public market space. And that means a lot of that savings gets passed on to the end investor. Also, the variability or the volatility of these particular funds tends to be much lower than a publicly traded bond fund. You're getting paid what's called illiquidity premium because what makes these alternative assets is that you can't just go to your corner brokerage and buy and sell them on the exchange every day. There's illiquidity involved, but you get paid a premium because you can't buy it and sell it every day. And that not only brings down the volatility, it increases the return over time.